President Trump expected to sign an executive order today to allow private assets and crypto assets into 401ks. Yes, it's a great opportunity for private equity to have access to these funds. For our purposes, I think the bigger conversation for us is to whether this is good or bad for investors. Josh, this is in your wheelhouse if ever an issue was.
Yeah.
What do you think about this?
I wrote a 3,800-word blog post about this on Monday. So if anyone wants to go to Downtown Josh Brown and get my expanded thoughts. But big picture, Judge, I like the idea of there being choice. I just question whether or not, if we all agree it's very hard to pick an active stock mutual fund in advance that's going to outperform, and I think most people would agree that's not easy to do. The amount of dimensions of things that could go wrong with private markets is like 10x. So I would equate picking a public stock mutual fund to playing chess. This is like a 12-sided Rubik's Cube. You've got liquidity issues. You've got opacity. You can't actually do due diligence on the underlying assets. You really have to rely on the fund sponsor to do that. There are a lot of different reasons why most people don't need this. That being said, if you're dying to have your money, at least a sleeve of it, in private equity, private credit, there are probably worse ways to do it. If you do it in a sleeve of your 401k and the fees aren't egregious, maybe it works out. My personal opinion is it's a nice to have, not a necessary to use.
The individual investor already has access to these products. They haven't had them through their 401k or retirement plans, but they have had access to them.
High net worth people have
yes,
had
but
access
even lower net worth through platforms like we go out to the CASE conference every year, which is a platform that connects the asset managers like the private equity firms to the RIA community, so that the regular Joe.
These are for $500,000 allocations. Now we're talking about a 401k. A person allocating $5,000.
I understand, but there's a definite difference between the two.
Yeah.
But this is not the first foray that regular investors have had into the alternative universe. This just ups the ante when you start talking about retirement plans.
It does, but also you can buy these through BDCs. You can buy Ares, you can buy Sixth Street Lending, which is what we own. You can own some of the Golub funds, and you're getting access to private capital, to private credit, right, through those. Why not go that way? Hercules,
well, in a 401k, people aren't buying individual tickers. That's why. The point is, it's an $8 trillion honeypot. The 401k market, it's $8 trillion. If private equity can get to 5%, they're at zero now, okay? 5%. That's 400. I mean, we're talking about $400 billion, and the fees on these funds are substantially higher than the funds that are traditionally used, like life cycle funds or index funds, which are 3 basis points. Now you're going to have people paying 100 basis points. Well, what are they getting for that 100 basis points that they weren't getting from the plain vanilla index? My question is, like, you really think that's the route to outperform the S&P?
No,
well,
not
it's
at
a diversification tool.
Okay.
You have to
maybe
asset allocation, like 5%, 10% max in terms of exposure to private credit or private equity or private markets in general, especially given the liquidity. My concern is I'm not sure. Lack thereof, right? Like that's what bothers me, because I'm not sure private investors or retail investors understand or appreciate these are long-tailed assets. You're not getting your money back for a very long time. I know it's 401k, so maybe they're not expecting that, but this is not something like I can just go sell tomorrow.
No, but the other side is that the world's evolved. I mean, people are looking for different kinds of assets beyond just stocks and traditional bonds.
But they're not going to be uncorrelated.
Right.
So this is unfortunately, Cliff Asness calls this volatility laundering. If you've got a portfolio of private company securities, whether they're bonds or stocks, and then you've got public corporate bonds and U.S. stocks, and you get into a recession, you're not getting that diversification benefit in real life. What you are getting is a delay between when you find out how much you're down. The private equity funds get to mark their portfolios periodically, whereas public stocks are marked to market every second of every day. But it's not like private equity is going to outperform in a negative environment or substantially outperform in a great environment. There's just sort of like a timing mismatch between when you actually learn what the pricing is.
Yeah, Josh, two more things on that too. First of all, you said 1% fees. That's being generous. That's like maybe at the top line what you're seeing. We all know.
You think higher?
It's obvious.
They're going to create new products though for 401ks.
Maybe, but you still know there's so many layers. There's so many hands in the pot. Like if you actually did forensic accounting on that, the fees would be really bad. One other thing that's very important.
Quick, please.
One of my family members just had another family member pass away. It was an 80-plus-year-old whose portfolio had been loaded up with these private vehicles, now passes down to the 3 kids, right? The 3 kids now all have inherited IRAs. They have all these private vehicles in them. They don't unlock for between 4 and 12 years. So they can't even access their money. I don't know why someone put an 80-year-old into these super locked up. Okay, fine, fine. We all do. And that goes back to the fee comment, right? And how many layers of fees. But I think there's a very pragmatic, very realistic downside to these, which is it's a problem. Like it was easy enough to pass them down to the kids, but now the kids are stuck when they actually need that liquidity.